Here is a beginner-level corporate finance manager quiz that covers financial planning and strategy, budgeting and forecasting, and capital structure management. Let's go. Question 1. What is the primary goal of financial planning in a corporation? A. Maximizing short-term revenue. B. Increasing employee salaries. C. Ensuring long-term financial stability. And D. Reducing customer complaints. Answer: ensuring long-term financial stability. Question 2. Which of the following is a key component of financial strategy? A. Choosing office furniture. B. Investment decision-making. C. Hiring new employees. And D. Planning office events. Answer: investment decision-making. Question 3. Financial planning helps a company. A. Determine its financial needs and objectives. B. Reduce employee workload. C. Avoid customer service complaints. And D. Eliminate the need for accountants. Answer: determine its financial needs and objectives. Question 4. A well-structured financial strategy should focus on A. Increasing product prices only. B. Managing cash flow and profitability. C. Expanding business without financial constraints. And D. Ignoring market conditions. Answer: managing cash flow and profitability. Question 5. What is a common tool used in financial planning? A. SWOT analysis. B. Employee feedback survey. C. Social media report. And D. Balance sheet. Answer: balance sheet. Question 6. Which financial document provides a snapshot of a company's financial position at a specific time? A. Income statement. B. Balance sheet. C. Profit forecast. And D. Cash flow projection. Answer: balance sheet. Question 7. The financial strategy of a company should align with A. The company's long-term objectives. B. Short-term employee preferences. C. The CEO's personal preferences. And D. Market rumors. Answer: the company's long-term objectives. Question 8. What is the purpose of budgeting in a company? A. To randomly allocate funds. B. To reduce the number of employees. C. To ensure controlled financial planning. And D. To increase taxes. Answer: to ensure controlled financial planning. Question 9. A financial forecast is used to A. Reduce employee benefits. B. Track historical sales. C. Increase marketing expenses. And D. Predict future financial performance. Answer: predict future financial performance. Question 10. The difference between budgeting and forecasting is that A. Budgeting sets financial targets, while forecasting predicts future performance. B. Forecasting sets financial targets, while budgeting predicts future performance. C. Both are the same process. And D. Budgeting is done only once a year. Answer: Budgeting sets financial targets, while forecasting predicts future performance. Congratulations on completing 10 questions. Let's move ahead. Question 11. What is a key characteristic of an effective budget? A. Based on past financial mistakes. B. Flexible and adaptable. C. Rigid and unchangeable. And D. Ignored by management. Answer: flexible and adaptable. Question 12. Which of the following is not a type of budgeting method? A. Zero-based budgeting. B. Incremental budgeting. C. Top-down budgeting. And D. Unlimited budgeting. Answer: unlimited budgeting. Question 13. A rolling forecast is A. A financial forecast that is updated regularly. B. A forecast for rolling stock and machinery. C. A fixed forecast for the entire year. And D. A method used only by startups. Answer: a financial forecast that is updated regularly. Question 14. Which budgeting method requires all expenses to be justified for each new period? A. Incremental budgeting. B. Zero-based budgeting. C. Flexible budgeting. And D. Cost-plus budgeting. Answer: zero-based budgeting. Question 15. What does capital structure refer to? A. A company's investment in furniture and equipment. B. The organizational structure of the finance department. C. The mix of debt and equity used to finance a company. And D. The company's marketing strategy. Answer: the mix of debt and equity used to finance a company. Question 16. Which is a source of debt financing? A. Issuing bonds. B. Selling company products. C. Increasing employee wages. And D. Paying dividends. Answer: issuing bonds. Question 17. What is an advantage of equity financing? A. Requires high interest payments. B. No obligation to repay investors. C. Reduces company ownership. And D. Increases financial risk. Answer: no obligation to repay investors. Question 18. A highly leveraged company has A. No external funding. B. A higher proportion of equity in its capital structure. C. A higher proportion of debt in its capital structure. And D. A strong employee training program. Answer: a higher proportion of debt in its capital structure. Question 19. Which financial ratio is used to measure a company's leverage? A. Return on investment. B. Inventory turnover ratio. C. Gross profit margin. And D. Debt to equity ratio. Answer: debt to equity ratio. Question 20. Which of the following is a disadvantage of debt financing? A. It dilutes ownership. B. Interest payments can burden cash flow. C. It does not need to be repaid. And D. It decreases company creditworthiness. Answer: interest payments can burden cash flow. How many did you get right? Comment below and subscribe for more.